So Warren Buffett is widely considered to be one of the greatest investors of all time. But if you were to ask him whom he thinks is the greatest investor, then he would probably mention one man, his teacher, Mr. Benjamin Graham. Graham was an investor and investing mentor who is generally considered to be the father of the security analysis and the value investing. His ideas and methods on investing are well documented in his books, Security Analysis, written in 1934, and The Intelligent Investor, written in 1949, which are two of the most famous investing texts ever written. These texts are often considered as the best reading material for any new investor, but they are not easy reads. In this video, we'll condense Graham's main investing principles and give you a head start on understanding his winning philosophy. Let's start with the principle number 1. Always invest with a margin of safety. Margin of safety is the principle of buying a security at a significant discount of its intrinsic value, which is thought to not only provide high return opportunities but also to maximize the downside risk of an investment. In simple terms, Graham's goal was to buy assets worth 1 for 50 cents, and in his times he did this very well. To Graham, these business assets may have been valuable because of their stable earning power or simply because of their liquid cash value. For example, it was not uncommon for Graham to invest in stocks where the liquid assets on the balance sheet, that is net of all debt, were worth more than the total market cap of the company, which is also known as nets to Graham followers. This means that Graham was effectively buying businesses for nothing. While he had a number of other strategies, this was the typical investment strategy for Mr. Graham. This concept is very important for investors to note down, as value investing can provide substantial profits once the market inevitability reevaluates the stocks and ups its price to a fair value. It also provides protection on the downside if things don't work out as planned and the business falters. The safety net of buying an underlying business for much less than it is worth was the central theme of Graham's success. When chosen carefully, Graham found that a further decline in these undervalued stocks occurred infrequently. While many of Graham's students succeeded using their own strategies, they all shared the main idea of the margin of safety. Now it's time to discuss about the principle number 2. Expect volatility and profit from it. Basically, investing in stocks means to deal with volatility. Instead of running for the exits during times of market stress, the smart investor greets downturns as a chance to find great investments. Graham illustrated this with the analogy of Mr. Market, the imaginary business partner of each and every investor. Mr. Market offers investors a daily price quote at which he would either buy an investor out or sell his share of the business. Sometimes he will be excited about the prospects for the business and quote a very high price. Other times he is depressed about the business prospects and quotes a very low price. Because the stock market has these same emotions, the lesson here is that you shouldn't let Mr. Market's views dictate your own emotions, or worse, lead you into your investment decisions. Instead, you should form your own estimates of the business's value based upon a sound and rational examinations of the available facts. Furthermore, you should only buy when the price offered makes sense and sell when the price becomes too high. Put another way, the market will fluctuate, sometimes wildly, but rather than fearing volatility, use it to your advantage to get bargains in the market or to sell out when your holdings become way overvalued. Two strategies that Graham suggested to help mitigate the negative effects of market volatility are number 1, dollar cost averaging. Dollar cost averaging is achieved by buying equal dollar amount of investment at regular intervals. It takes advantage of dips in the price and means that an investor doesn't have to be concerned about buying his or her entire position at the top of the market. Dollar cost averaging is ideal for passive investors and alleviates them of the responsibility of choosing when and what price to buy their positions. And the number 2 is investing in stocks and bonds. Graham recommended distributing one's portfolio evenly between stocks and bonds as a way to preserve capital in market downturns while still achieving growth of capital through the bond income. Remember, Graham's philosophy was first and foremost to preserve the capital and then to try to make it grow over time. He suggested having at least 25 to 75 of your investment in bonds. He suggested that you should have 25 to 75% of your investment into bonds and varying this based on market conditions. This strategy had the added advantage of keeping investors from the bottom, which leads to the temptation to participate in unprofitable trading. The principle number 3: what kind of investor you are. Graham advised that investors know their investment selves. To illustrate this, he made clear distinctions among various groups operating in the stock market: active versus passive investors. Graham referred to active and passive investors as the enterprising investors and defensive investors. You only have two real choices. The first choice is to make a serious commitment in time and energy to become a good investor who equates the quality and amount of hands-on research with the expected return. If this is not your cup of tea, then be content to get a passive return, but with much less time and work. Graham turned the academic notion of risk as return on its head. For him, work is return. The more work you put into your investments, the higher your return should be. If you have neither the time nor the inclination to do quality research upon your investments, then investing in an index is a good alternative for you. Graham said that the defensive investor could get an average return by simply buying the 30 stocks of the Dow Jones Industrial Average in equal amounts. Both Graham and Buffett said that getting even an average return, such as the return of the S&P 500, is more of an accomplishment than it might seem to you right now. The fallacy that many people buy into, according to Graham, is that if it's so easy to get an average return with little or no work, then just a little more work should yield a slightly higher return. The reality is that most people who try this end up doing much worse than the average. In modern times, the defensive investor would be an investor in the index funds of both stocks and bonds. In essence, they own the entire market, benefiting from the areas that perform the best without trying to predict those areas ahead of the time. In doing so, an investor is virtually guaranteed the market return and avoids doing worse than average by just letting the stock market overall results dictate long-term returns. According to Graham, beating the market is much easier said than done, and many investors still find they don't beat the market. At last, I would like to request you all to please take a look on speculator versus investor. Not all people in the stock market are the real investors. Graham believed that it was critical for people to determine whether they were investors or speculators. The difference is very simple. An investor looks at a stock as a part of his business and the stockholder as the owner of the business, while the speculator views himself as playing with expensive pieces of paper with no intrinsic value. For the speculator, value is only determined by what someone will pay for that asset. To paraphrase Graham, there is intelligent speculating as well as intelligent investing. The key is to be sure you understand which you are good at. So these are my personal learning from Benjamin Graham. If you find this video knowledgeable, then please make sure to like this video and support our channel. And please don't forget to subscribe for more beautiful content. Thanks for watching our video. Have a nice day.